Zscaler reported earnings after the close today. Let me read you the headline numbers. Revenue of $850.5 million, up 25% year over year. That beat Wall Street's estimate of $835.6 million. Non-GAAP EPS of $1.08. That beat the consensus estimate of $1.01. Annual recurring revenue of $3.525 billion, also up 25%. Record non-GAAP operating margin of 23%. The company raised its full-year revenue guidance, raised its full-year EPS guidance, raised its full-year ARR guidance, and the stock crashed 16% after hours, from $184.60 at the close to $154.29 within minutes. A $5 billion market cap wipeout on a quarter where they beat everything and raised guidance. If you only read the financial media headlines tomorrow, you will see something like Zscaler falls on mixed guidance, or FCF margin concerns pressure ZS. That is not analysis. That is description. And it misses the single most important market signal of this holiday-shortened week. Zscaler did not fall because they missed. They fell because of what the market is now demanding from growth stocks in this AI regime. And what happened to ZS tonight is the template for what will happen to Salesforce, Snowflake, and MRVL tomorrow, unless they deliver something that is not in any analyst model. I'm Daniel Reed. This is Market Lens. Let's get into the data. Let me be precise about what Zscaler actually delivered tonight, because the binary beat-miss framework the financial media uses is functionally useless for understanding what just happened. The quarter itself? Flawless. Revenue, $850.5 million versus $835.6 million expected. A beat of $14.9 million or 1.8%. Non-GAAP operating margin hit 23%, an all-time record. They added 748 customers generating over $1 million in ARR. They closed on the Symmetry Systems acquisition to strengthen their AI security position. AI Protect bookings passed $100 million in the past year. Data security ARR is now over $500 million. Full-year guidance, raised. Revenue from $3.322 billion to $3.330, $3.333 billion. EPS from $3.99, $4.02, to $4.10 to $4.11. ARR from $3.730, $3.745 billion to $3.74 to $3.749 billion. So what was the problem? Two numbers, both in the fourth quarter outlook. First, Q4 revenue guidance of $875 to $878 million. The midpoint is $876.5 million. Wall Street was at $879 million, so they missed by $2.5 million, $2.5 million, in a company doing $3.3 billion in annual revenue. Second, free cash flow margin. They guided 22.8% to 23.3%, down from their prior guidance of 26.5% to 27%. Why? Higher capital spending. They are pulling forward equipment purchases from fiscal 2027 into Q4 fiscal 2026 to lock in pricing. That is a timing issue. It is cash flow moving from one quarter to another. It is not a deterioration of the business model. And for that, a $2.5 million revenue guide miss and a capex timing decision, the stock fell 16%. This is the reckoning. This is what happens when a stock that has rallied 28% in a month, heading into earnings, meets a market that no longer rewards good enough. The real question tonight is not why Zscaler fell. It is, what does this mean for the rest of the earnings parade? Let me show you the pattern that nobody is talking about. This is Zscaler's post-earnings price action history. February 2026, beat on both lines, raised guidance. Next day, 12.2%. November 2025, beat on both lines. Next day, 13.0%. September 2025, mixed. Next day, 1.5%. May 2025, beat. Next day, plunged 9.8%. Notice the inflection point. The last time a Zscaler beat was actually rewarded was May 2025. Every beat since then, November, February, tonight, has been sold aggressively. The average day plus one move after a beat in the last 3 quarters, minus 13.9%. This is not a Zscaler problem. This is a software sector regime change. The market is now bifurcating in a way we have not seen in this entire AI cycle. AI infrastructure layer, NVDA plus 127% year-to-date, MRVL plus 130% year-to-date, MU just crossed $1 trillion in market cap today. These are the companies selling the picks and shovels. They make the chips, they make the networking equipment, they make the memory that goes into every AI data center. Enterprise application layer, CRM, minus 32% year-to-date. ZS, minus 19% year-to-date. Snow, minus 22% year-to-date. These are the companies selling software to enterprises. They were supposed to be the second leg of the AI trade. They have instead become the source of capital to fund more bets on the infrastructure layer. This is the gap that nobody in the mainstream financial media is explaining properly. NVIDIA reports $81.6 billion in revenue, up 85% year-over-year, guides to $91 billion next quarter, and the stock goes up. The message is clear. Hyperscalers are spending at extraordinary rates on AI infrastructure. But then you look at the enterprise software names that are supposed to benefit from all that AI infrastructure, and they are down 20 to 30% on the year. Why? Because there is a growing suspicion in the institutional market that AI is not adding to software revenue, it is cannibalizing it. Think about Salesforce's business model. It is seat-based, you pay per user. If Agentforce, their AI agent platform, can automate the work that previously required 3 human beings, does that mean the enterprise needs 3 Salesforce licenses? Or 1? This is the question that is now being priced. And Zscaler's reaction tonight is the market firing a warning shot across the entire software complex. Prove your AI products are additive, not cannibalistic, or your multiple contracts. Tomorrow after the close, we get 3 of the most consequential earnings reports of this entire quarter. All 3 now have a much higher bar to clear, courtesy of what happened to Zscaler tonight. Let's go through them one by one with the actual setup that matters, not the analyst consensus numbers you can read anywhere. First, Salesforce, CRM. The setup, down 32% year-to-date, down 36% over the past year. This despite beating earnings expectations in each of the past 4 quarters. The question is not whether they will beat the $3.12 EPS or $11.05 billion in revenue. The question is Agentforce. Last quarter, management disclosed Agentforce ARR $800 million, up 169% year-over-year. 29,000 deals, up 50% quarter-over-quarter. 2.4 billion agentic work units delivered. Those are impressive numbers. But here is the problem that is now being priced. $800 million in ARR for Agentforce, while Salesforce's total ARR is north of $35 billion. That is 2.3% of the business. The market is not asking whether Agentforce is growing fast. It is asking whether it is growing fast enough to offset the organic deceleration in the legacy CRM and Service Cloud businesses, and whether those 2.4 billion agentic work units are replacing seats rather than augmenting them. The bar after Zscaler tonight. They need to show Agentforce ARR accelerating past $1.1 billion. They need to give a specific number for how many Agentforce customers are actually expanding their overall Salesforce spend, not just shifting it from legacy products. And they need to reaffirm second-half organic re-acceleration with conviction. If they just deliver a solid beat and raise like Zscaler did, watch out. The ZS template applies. Second, Snowflake. The setup, down 22% year-to-date. Options market pricing a 13.5% move. Snowflake is the cleanest read on whether AI workloads are actually running in enterprises. Their model is consumption-based. You pay for what you use. When AI workloads spike, their revenue spikes. When enterprises freeze IT budgets, their revenue decelerates. Last quarter setup was strong. RPO $9.8 billion, up 42% year-over-year. 1 deal over $400 million. 7 additional 9-figure contracts. More than 9,000 customers using AI-related tools. Snowflake Intelligence expanded to nearly 2,500 accounts within 3 months. The question now, is that consumption growth continuing? And can they maintain margins while AI workloads, which currently carry lower gross margins, scale? Management is guiding approximately 75% product gross margin for FY 2027. The market will be listening closely for whether AI margin dilution is temporary or structural. Third, Marvell Technology, MRVL. The setup, up 130% year-to-date. The stock is now trading above the consensus analyst target price. That is extraordinarily rare. It means the analysts are playing catch-up while the market keeps moving. This is the most interesting one of the three, because it is on the right side of the infrastructure versus software bifurcation, but it is priced to absolute perfection, 64x PE. Options pricing a 13.7% move. Last quarter, data center revenue up 42% year-over-year. Custom silicon business generated $1.5 billion in fiscal 2026, having doubled. Management guided custom revenue to grow more than 20% in fiscal 2027 and at least double again in fiscal 2028. The bull case. MRVL is the alternative to NVIDIA. When hyperscalers want custom AI chips, XPUs, rather than general-purpose GPUs, they come to MRVL. Amazon's Trainium, Google's TPU companion chips. All 5 major U.S. hyperscalers are expected to receive MRVL's DCI modules this fiscal year. The risk: the entire AI infrastructure trade is 1 quarter away from a sell the news event if guidance does not accelerate. And remember, NVIDIA just guided $91 billion next quarter. That sets a very high bar for the entire semiconductor complex. What MRVL needs tomorrow? They need to beat the $2.4 billion revenue consensus. They need to raise Q2 guidance. They need to say something specific about Google, who the information reports is in active discussions for 2 custom AI chips. And they need to reaffirm the $500 million CPO annualized run rate by Q4 fiscal 2028 milestone. If they do that, the stock could hold its gains. If they just deliver an inline quarter, a stock that is up 130% YTD and trading above analyst targets does not react well to good enough. Not after what happened to Zscaler tonight. Let me pull this together into a thesis that you will not hear on CNBC tomorrow. What happened to Zscaler tonight is not an isolated reaction to a $2.5 million revenue guide miss. It is a regime change signal. The market is now actively differentiating between 1. Companies that build the AI infrastructure. These are being rewarded with multiple expansion. 2. Companies that sell software into enterprises. These are being re-rated downward on concerns that AI automation will ultimately reduce required seat counts and contract values. Micron Technology crossed $1 trillion in market cap today. Let that sink in, a memory company. That is how powerful the infrastructure build-out thesis is right now. Meanwhile, Salesforce, the world's #1 CRM company with $41.5 billion in annual revenue, trades at a fraction of its former multiple because the market doubts whether AI will be additive to their business model. This is the most important dynamic in markets right now, and it is playing out in real time this earnings week. Now let's talk about what actually matters from here. The framework I'm using this week is simple. For software names, CRM, Snow, Okta, MDB, Path, the bar is now extremely high. A garden variety beat and raise will be sold, just like Zscaler was sold tonight. They need to deliver specific, quantified evidence that AI products are driving net new revenue, not just cannibalizing existing contracts. For infrastructure names, MRVL, Dell, the bar is also high, but for a different reason. These stocks have already rallied 100% plus. They need to deliver accelerating guidance to justify the multiple. If they merely meet expectations, the sell the news risk is real. And for the broader market, the S&P 500 and NASDAQ both closed at all-time highs today. The VIX is at 16.2. There is a lot of optimism priced in. Zscaler's reaction tonight is a warning shot. Beneath the surface of the index-level calm, there is a vicious re-rating happening at the individual stock level. Companies that cannot prove their AI narrative is translating into profitable, non-cannibalistic growth are being punished severely. And this is happening while the indices are at all-time highs. That is the kind of divergence you see late in a cycle, not early. Now let's talk about what to watch for the rest of this week. Tomorrow after close, CRM, Snow, MRVL, SNPS, HPQ. I have already given you the framework. Thursday after close, Dell, MDB, Okta, Path, Cost. Dell deserves special mention. The stock is up 97% year-to-date. It jumped 16% in a single day earlier this month on a Wells Fargo upgrade. It is the most direct read on AI server build-out outside of the pure semiconductor names. If Dell guides strongly, it confirms the infrastructure thesis is real and has further to run. And Friday, PCE inflation. The core PCE price index is expected to print at 3.3% year-over-year. That would be the fastest since late 2023. Fed Governor Waller already said the next rate move is just as likely to be a hike as a cut. A hot PCE print would shift those odds dramatically. But here is what I want you to remember most from tonight. Zscaler beat on revenue, beat on EPS, delivered record margins, raised full-year guidance across the board. and fell 16%. That tells you everything you need to know about the current market psychology. Good is no longer good enough. You need to be perfect. And even perfection might not save you if your business model sits on the wrong side of the AI cannibalization question. Keep your data sharp and your logic sharper. I'm Daniel Reed. This has been Market Lens.